Hi guys, so welcome to our series of 365 days, 365 concepts. Today we would be discussing the concept of revenue recognition. So let's get started. So have you guys ever wondered how a company decides the sales figures that is presented on their income statement, the revenue figure that is presented on the very top of the income statement? Is it simply the total cash that has been received by the company during the year for which they are filing the statements, or is it more to it? So the simple answer is no, it is definitely more to it. There is definitely more to it. So let's take an example. Let's take an example of a firm or something which is everybody these days using to binge watch their content, that is Netflix. Let's imagine Mr. A has paid or basically subscribed to a yearly subscription of $1,200 with Netflix, right? Now let's imagine that this 1,200 was being paid at the end of the 11th month for year one, the year for which Netflix is currently presenting its income statement or other financial statements, right? So if this money was paid in the end of the 11th month, effectively the beginning of the 12th month, what do you think would be the revenue amount that would be recorded in Netflix income statement? It would be only for that 1 month. Reason being, Mr. A is able to access the content of Netflix for 1 month, and in the same breath of thought, Netflix is only providing the content services to Mr. A for 1 month during that year, the year for which it is filing its financial statements, including the income statement, right? So for year one, only $100, which is nothing but 1 by 12 into 1200. That is what is going to get represented as revenue for the very first year. As we move on to year two, since it was a yearly subscription, during year two, for the first 11 months, Mr. A will be able to access the content that Netflix is providing. Netflix is offering that service for the 11 months in year two. So the remaining 1100 will be recorded as revenue in the next year and not in the year in which the money was basically received, right? That's how revenue recognition happens. Now, what is it that is compelling us to recognize revenue in such a fashion? The answer is revenue recognition principle. The revenue recognition principle dictates that whatever amount of goods or whatever amount of services have been offered, that amount will only be recorded as revenue. Since only $100 worth of service was provided by Netflix during year one, only that much amount will be recognized as revenue by Netflix in year one, and the rest will be recorded in the next year when that remaining service is being provided. So, in the end, we can say it is not about the cash received, but the value that has been delivered. That is what sits at the center of the revenue recognition principle, and that is how companies basically come up with the revenue figure that's there on their income statement. So, that's it for today, and we will see you with another concept on another day.